the Great Depression was something of a perfect storm. If the Fed tries to fight this sort of inflation, it could very easily create a recessionary environment.
Is inflation enough to cause a Great Depression?
The best thing that the U.S. authorities can do is
talking about the future of global trade and whether or not protectionism is now a global theme, which may lead to another Great Depression. We'll talk about what happened in the last Great Depression, what caused it, and what caused it to end, and which metals or assets or perhaps securities may be the best bet in the future. George Selgin joins us once more. He is the former senior fellow at the Cato Institute and the author of several books, including The Theory of Free Banking and his 2025 book, which we'll be focusing on today, False Dawn, The New Deal and the Promise of Recovery. Welcome to the show, George. Good to see you.
Thanks, David. I'm glad to be back on again.
Well, this is a very interesting time that we're living in, and I'd like to talk about some of the themes from your book, False Dawn, and extrapolate to today's scenario. Let's start with this. What caused the Great Depression? Many economists believe that it was a conglomerate of different things, including the Smoot-Hawley tariffs that ultimately triggered huge contraction in growth, economic growth. And if we extrapolate that to today, we have a situation where the entire world has been engaged in a multi-month trade war with each other, raising tariffs and raising protectionist borders. Why aren't we in a Great Depression yet, though, George?
Well, you said it, David. The Great Depression was a result of a conglomerate of causes, not just one cause. And although the Smoot-Hawley tariff famously contributed to the downturn, which was a world downturn, of course, this was a world. The Smoot-Hawley tariff was a set of U.S. tariffs, but the world responded with retaliatory tariffs. So we ended up with a general increase in tariff barriers, though that was one of several factors, but there were others that were at least or more important that have to be kept in mind in gauging the likelihood of a similar calamity today. And the other factors that were important, the most important, had to do with monetary systems and their collapse. So two things happened. Worldwide, or at least in the Western gold standard world, the gold standard that had been cobbled up into place after World War I, which was not the same sort of gold standard that existed before that war, fell apart. It unraveled. It was a very fragile arrangement designed to economize on gold and let central banks around the world get by with less of it than they once needed. But it started to fall apart when the cooperation that was required to keep this gold standard on the cheap going started to break down in the late 1920s. So that was one factor in forming a general collapse of money supplies, spending, credit, etc. In the United States, we had a second factor because we had a very weak banking system. And the result of that, again, after World War I, and partly to a large extent for reasons that have to do with changes that occurred in World War I, we started seeing thousands of banks fail every year in the 1920s. Mind you, we had about 32,000 to start with, but still they failed in very significant numbers in the 20s. And then when the stock market crash came in the U.S. in 1929, that led to even more bank failures. So you had a world monetary system, a gold standard monetary system that was already unraveling. And at the same time, big parts of the U.S. monetary system started to collapse, the banking system specifically, that compounded the extent of the monetary collapse in the United States. So the U.S. found itself in real doo-doo. And the Smoot-Hawley tariff kicked in after all these problems were taking effect, and aggravated the consequences for the U.S. and the rest of the world as well. So there you have some of the major factors. There were others as well that contributed, including, of course, bad economic policies, some of which, not just policies like Smoot-Hawley, but some of the policies implemented by some countries, including the United States, in response to the Depression, to some extent in an effort to end the Depression, turned out to be counterproductive and made things worse. So these are all part of the story of the Great Depression. The reason I'm mentioning so many factors is to make clear that it was something of a perfect storm, the Great Depression. And we should be glad to think it was, because that means that even though some of the factors like trade barriers are in place today that were contributing factors in the Great Depression, I don't think that enough of the things that went wrong in the 1930s are likely to go wrong again. So though we may be in for trouble, I don't think we'll be in for quite the kind of trouble that we saw in the 1930s.
Because we have a more robust banking system, or perhaps we have a more robust capital markets, or perhaps governments and central banks around the world are more likely to enact stimulus. So why won't we have?
I think that all of those things are true to some extent. It's very dangerous, of course, to speak of the robustness of the U.S. banking system in particular, because we've seen that it is not quite as robust as people thought it had become after the episode in the 1930s. So it's not as if it's a fail-safe system. However, for various reasons, I think the kind of collapse of the banking system that happened back then is unlikely to happen again. And I think that the same is true in the world. We did learn some lessons from the Great Depression, one of which is that monetary and fiscal stimulus have a place. They didn't do much of either in the 1930s in the United States. They did less than people assume, and that's something my book talks about. But we learned two lessons. I think economists have learned two lessons that policymakers have also gotten the word about. One is the positive lesson that you want to get demand and spending back up. If your banking system collapses, you want to have something to prop it back up again. But the other lessons were negative. That is, we learned that there are some things you shouldn't do in order to try to end a depression. And I don't think we will repeat some of those errors of commission. So I think that all told, we're less likely to have a Great Depression. We could certainly have another recession. It could certainly be serious, but not that serious.
Before we continue with the video, let's talk about one of the most critical minerals of our economy, copper. Now, copper grades are declining globally. The majors are struggling to keep their mills fed, which brings me to today's sponsor, Algo Grande Copper Corp, ticker ALGR, and their Adelita project in Sonora, Mexico. Sonora is one of the most established copper-producing regions in the world. Adelita sits inside it as a high-grade copper deposit, a type that's increasingly rare and increasingly strategic. Phase 1 drilling has already returned strong results, including 18.2 meters at 1.8% copper equivalent. But this isn't a single hole story. The company has identified multiple high-grade systems along a 6-kilometer corridor, with geological work pointing to potential large-scale copper at depth. Phase 2 drill targets are already being defined. The technical team includes Peter Megal of Mag Silver and Raymond Janis of Atex Resources, both with proven track records in this type of geology. Ticker is ALGR. Scan the QR code here or go to the link in the description down below to learn more. Okay, so what brought the U.S. out of the Great Depression? Was it the New Deal? Or was it World War II and industrialization?
It wasn't exactly either of those, David, though those are the popular explanations. One is that New Deal programs helped end the Depression. Some of them did, but they didn't suffice. And the other is that World War II did it, and that answer is unsatisfactory for a reason I'll get to. As far as the New Deal is concerned, the big problem is that although Roosevelt took some steps with the Hoover administration's help, I should add, that prepared the stage for recovery. He stabilized the banking system, implemented a bank holiday, closed the banks, and then reopened them gradually in a way aimed at restoring confidence in the banking system. He loosened the gold standard ties that by that time had to be loosened simply because the public had been running on gold and there was no way to retain the old gold standard. All of these things were steps that could have led to recovery and were expected for a while to lead to recovery. But the Roosevelt administration didn't take much advantage of either of them. There was relatively little fiscal stimulus, despite what people think. More importantly, though, the monetary system did not do anything to revive that is, the Federal Reserve did nothing under the Roosevelt administration to deliberately try to make up for the monetary collapse that had taken place during the 3 years leading up to Roosevelt's taking office. You can look at Federal Reserve credit during the 1930s after Roosevelt's nomination or inauguration, pardon me, and you'll see it's totally flat. The main thing that was driving what recovery did take place in the United States in the 30s was massive amounts of gold flowing into the United States after 1933, even starting a little bit earlier. And mostly that was because of war fears in Europe that were mounting at this time, especially as Hitler gained power. So gold is flowing into the US, and this is spurring recovery. But the Roosevelt administration, far from welcoming that, took steps that stopped gold from having the positive influence it was having. It surprised people to hear it, but the Roosevelt administration, including folks at the Fed, they thought all this gold flowing into the country was bad news. It was going to start another boom-bust cycle and all that. Even though it was a lack of gold that precipitated the collapse in 1933. So they took some steps to stop it. Before they did that, they implemented various New Deal programs, and some of those were extremely counterproductive. The most counterproductive, and most economists will say this, I'm hardly unique in much of what I'm saying, was the National Recovery Administration. This was the setup that implemented price codes in industries that they had to follow, essentially organizing cartels or encouraging industries to form cartels to raise prices, set high prices, set higher wages. But high prices and wages are something that may have been desirable as a result of more spending. But imposed through controls, they just led to worsening unemployment and made the downturn that much more severe. So between not letting gold do its thing especially after 1936, and imposing these controls before then, the administration in important ways stood in the way of what could have been a more rapid recovery. So that's quickly on the 30s. As for World War II, well, yes, temporarily World War II ends the Depression. While it's going on, of course, huge numbers of people are enlisted in the army. This solves for the time being the unemployment problem, and factories are set to work making bombers and that sort of thing. And so you no longer have the unemployment problem or the shut down factories that you have in the 30s. To that extent, you could say the Depression has ended, except it's only a temporary fix for the simple reason that the war ends. And in 1945, when the war ends, all those troops come back home looking for jobs very quickly. And the factories that the government was giving orders to stop getting the orders. So that source of demand dries up. Military spending goes down as a percent of GDP to almost where it was in 1939. So to explain how we really got out of the Depression, you can't appeal to the New Deal, and you can't just appeal to World War II. You have to say what changed after World War II so the Depression didn't come back, as many feared it would. at the end of the war. They thought it would come roaring back, the Keynesians particularly. They wanted to see the government renew or increase peacetime spending after World War II to make up for the full extent of the decline in military spending, which would have been a huge fiscal stimulus, of course, equal to that of the war itself. But that didn't happen. That did not happen. What happened, and this is the answer finally to the question, what happened was that during the war, the relationship between business and government changed from one of hostility toward business by the government, by the New Dealers, to one of cooperation. That was very important. It changed, the laws changed, the attitudes changed. Instead of legislation and rhetoric that scared businessmen and made them reluctant to invest, now you had circumstances after the war where businessmen felt that they could invest. Communism wasn't coming. The NRA had been repealed. There wasn't going to be a situation where they didn't feel likely to be able to reap the profits of their investments. And so what happens after the war is private investment takes off like a rocket. It had been almost dead for a decade. And that is what allows the economy to recover without the government having to provide substitutes for wartime fiscal stimulus.
Businesses and consumers in America and actually around the Western world are facing a few problems, two of which I'll address now. One is inflation and one is uncertainty. Let's talk about uncertainty first. Now, yes. The low hiring, low firing economy that a lot of people are referring to our economy now is currently in full blast, meaning we don't have a lot of unemployment. Jobless claims ticked up this morning to 214,000, but this is still in line within the historical range. And layoffs aren't surging across all sectors. Probably within tech, there are some notable headlines, but not across all sectors. But people still aren't hiring en masse. What needs to incentivize businesses? What needs to happen to the economy to incentivize businesses to start hiring a lot, which would boost wages ultimately?
Well, you mentioned it. Regime uncertainty or uncertainty about policy was a big factor in the New Deal's failure to get the U.S. economy out of the Depression. And what the war did was to end that uncertainty, create a more certain environment for the going forward. And that's part of that investment boom I spoke about. Well, with the tariff wars and other policy changes, and now the real war being fought in Iran, we've entered a period for some years now, a couple of years now, of very high regime uncertainty again. And that is a drag on the economy now, just as it had been in the New Deal. The exact causes of the uncertainty are different, though there's some similarities, like the tariff policies. But the uncertainty is high. And as a result, you don't have the investment and you don't have the robust job demand, demand for workers, and that you would have in an economy that was really feeling confident about the future. So we need more stable policies. We need more certainty about what the government is up to. The tariff situation seems to have stabilized somewhat. That helps, but only because the administration now has other things on its mind that are themselves creating uncertainty, because this war, particularly with its effect on the supply of oil, a very crucial input, is itself a cause of a lot of uncertainty going forward. So the other thing that needs to change, besides having, not toying with tariffs, we need to end this war, the war, and open the Straits of Hormuz and all that, and then we can see much better prospects for robust growth in employment and investment.
What is your view on inflation? A few things are happening right now. The Strait of Hormuz closure, as you know, as you just talked about, has made oil go up to nearly $100 a barrel, currently still around that level. Meanwhile, the Federal Reserve has ended quantitative tightening late last year. And we also have the CPI ticked up to the highest level since 2024, mostly because of oil. What is the future of inflation, in your opinion?
The future is not a happy future. All of the factors you mentioned make it quite likely that we will see inflation tick up well above the 2% target that still is considered an ideal by central bankers and the Fed in particular. And this has always happened when oil has become scarce. This has always happened when oil has become scarce. The role of oil shocks in inflation is one of the more well-established facts of modern economic history. So inflationary pressures are there, and it's the kind of inflation that is inflation due to oil shocks that is very hard to combat, because really the shocks are real. This is not just the Federal Reserve spitting out too much money. This is real resources becoming less available. If the Fed tries to fight this sort of inflation, it could very easily create a recessionary environment, which is what happened, by the way, in 2008. You had the Fed more worried about inflation, which was, again, mainly a result of adverse supply circumstances. And that was one of the Federal Reserve's stance as a result of that fear of inflation, contributed to the crisis of late 2008 and going forward, which Kevin Warsh was very much among those who were calling for Fed tightening in 2008, hawkish stance based on fear of inflation. So I think we're between a rock and a hard place because of the oil situation. We can either bear the almost certain increase of inflation that will occur unless the Fed was willing to try to suppress it, or the Fed will try to suppress it, will go hawkish, but that will put us into a recessionary situation. And I emphasize that the reason we're in a quandary is because the supply shocks are so important a factor, and Federal Reserve policy can't make supply shocks go away. It can just create demand shocks that offset this, that match the supply shocks. Prices don't go up so much, but we all suffer more as a result of this tightening that is trying to keep prices from going up as much as the real circumstances brought about by the war would have them do. So I think the situation as a result of the war is I think if the Fed does its job properly, we will see more inflation. If it doesn't try to put the brakes on excessively.
Is inflation enough to cause a Great Depression?
No.
High inflation?
No, it isn't. It can cause a lot of trouble, don't get me wrong. But no, I don't think it can cause a Great Depression very easily. You'd have to have, if you had a hyperinflation crisis, of course, you would have something that was perhaps as bad as the Great Depression, but it would be a very different sort of calamity. It would be painful, but it would not be the same, because in the Great Depression, the most significant fact was a collapse in spending and demand. About more than a third collapse of total spending in the economy. Obviously, if you've got hyperinflation, you've got a problem that's very different. Even if some of the inflation is due to supply factors, to have hyperinflation, you've got to have the Fed and other central banks contributing a lot as well. So the one thing you won't have is a shortage of money in those situations. Whereas in the 30s,
does high inflation and high unemployment usually go hand in hand?
No, not usually, but they can. They can. What happens is if high inflation goes on long enough, you get a lot of distortion in price signals. And then you end up with a lot more churning in labor markets. And so you can end up with high inflation as a result with stagflation. But in general, the most severe bouts of unemployment that we've had in the past have been a result of inadequate spending, not excessive spending. So in 2000, in the Great Recession, in the Great Depression, in COVID, in 1920, 21, in all of those episodes when unemployment rates got into double digits, the driving factor wasn't excessive money creation. It was, if anything, its opposite, as revealed or as manifested in a lack of spending in the economy.
So, George, the biggest problem facing Americans that, according to their own opinions, this is from the University of Michigan survey and other consumer surveys, is the unaffordability crisis. People can't afford homes. People feel like their wages are falling behind inflation. And maybe we're not in a Great Depression yet, but people don't feel prosperous. And in fact, the Consumer Sentiment Index is at an all-time historical low from the University of Michigan. What can be done to fix this problem?
Well, you have ultimately, you need real production, real GDP growth in order to have people feel well-to-do. And you need to have it, obviously, you need to have it not concentrated in just some wealthy portion of the population. Anytime we have a war and supply side constraints that we're experiencing now, as well as artificial constraints from tariffs, because those are constraints on trade that prevent it from contributing what it might to people's well-being. People are going to feel that. It's not so much the inflation. It's not so much the Federal Reserve creating too much money, because ultimately, if the Fed does that, not to a very great extent, wages do eventually tend to catch up. And so they go up as perhaps in some lag behind prices. But the most important factors that contribute to people's sense of not being so well off come from things that interfere with production, that reduce total production of real goods and services. And wars and tariffs are very high on the list. In fact, maybe the items 1 and 2 on how you can have on a list of things that can make an economy much less productive than it would be otherwise. So we have right now those 2 items ticked off on the list of bad things that you don't want if you want people to feel prosperous. Now, I want to add, studies I've seen show there's a great disconnect between what people think has happened with real wages, for example, over the years, especially medium real wages, and what has actually happened. So a lot of what you hear about how people are earning less than they used to in real terms, and I don't mean the rich, I mean ordinary workers. A lot of what is out being said and reflected in some of these opinion polls isn't borne out by careful statistical studies. I don't know what you make out of that. I'm not sure what to make out of it, but there does appear to be some disconnect between perception and reality. So that's also a factor in what's going on now. Not to detract from the real factors that really are making us poorer than we ought to be. There is also, as well, a certain amount of misperception behind the polls that you were referring to?
This came in from an article I was reading. This is from Google Trends, but Bloomberg put this together. Public interest in debasement. The debasement of the dollar exploded in late 2025.
Mm-hmm.
Why do you think that happened?
Well, I'm not sure what that very high figure, that big
Google searches for the word. Google searches for the word debasement. Yeah.
This is happened? Words. I see. Yeah. I see.
What happened late last year, or perhaps even early this year, that may have sparked people to? Well, this is late last year, so yeah.
The very end of 2025. It looks like. I don't know what that is, David. I will say that the word debasement is being used very loosely here. I think what people mean is what people should be worried about, and what many may be calling debasement, is just depreciation of the dollar, right? It's losing its value in terms of goods and services, in terms of foreign exchange, and so on. So that's just depreciation. Debasement, strictly speaking, is when you have a metallic standard, like a gold standard, and you decide that the government stops putting as much metal in the coins while pretending that they're worth just as much as ever. That's debasement. And it comes from base metal. You're adding base metal to dilute the actual precious metal in the coins. Anyway, I know that now we're veering into old economic history, but I think what people are referring to as debasement is just the depreciation of the dollar. Now, obviously, something's gone on at the very end of 2025 that made people more apprehensive about depreciation of the dollar. But I don't know exactly what event would have triggered that. I honestly don't know. Do you have any thoughts about it? I'm curious.
What happened at the end of 2025 that triggered a huge explosion in the interest of dollar debasement? See, this is, end of 2025. The Iran war didn't happen yet.
I think that this may have been a result of Trump's various pronunciamentos against the Fed and wanting to, put his man in and criticizing Powell. There was a lot of that going on. And I think people were worried about the Fed's independence. That would have to be my theory, but I don't recall anything specific happening on that, very slim period at the end of the chart. That's what's puzzling me.
Where I'm going with this is that public sentiment for public interest for dollar debasement at the time coincided with a surge in capital flows into gold. That probably is not a coincidence.
Yes.
So if you're concerned about,
They probably both link back, though, to the jawboning that Trump was doing, and his criticisms of Powell, and Powell's sticking to his, to his guns. This was a very public debate about the Fed's role in the economy and Fed independence and all that. And people took quite an interest in it. They really were very interested in this clash between Trump and Powell. And I'm sure that as a result of that interest, there was more interest in the whole question of the fate of the dollar and the need to protect yourself against any dollar depreciation. So I think it all traces back to that, but I think we have to go back and look at our calendars and check the news for that date and see if we can't pinpoint something more specific.
If you're concerned about dollar debasement, the question is, where are you going to go if you're living in a dollar regime? So, by the way, a dollar regime could be U.S., it could be a country that has been dollarized and they use a de facto dollar, so it doesn't even have to be just U.S. But let's take a look at this article. Trump's strategic Bitcoin reserve makes no sense. You wrote this in March. Why doesn't it make any sense? Proponents of the Bitcoin reserve cite the fact that, we have a gold reserve, why not a Bitcoin reserve?
Well, first of all, let's be clear that if people want to protect themselves against depreciation of the dollar, they need strategic hedges, right? The government having a strategic hedge doesn't make any sense. It's got the dollars. It gets to depreciate the dollars and profit from it. The public is the one it needs to protect itself. So even if Bitcoin were a very good inflation hedge, that would be an arc, and we worry and we think there's great risk of future inflation or depreciation. That's a great argument for all of us privately making up substantial private Bitcoin reserves, if all those things are true. It's not an argument for the US government doing so. The US government doesn't have to hedge against depreciation of the US dollar. So there's a lot of misconception about this. Let me talk about gold before we come back to Bitcoin. Many central banks have been accumulating gold lately. And again, for many of those central banks, it makes sense. Why? Because gold does have a good record as a hedge against inflation. But the central banks in question aren't issuing dollars. They're not dollarized. They need to hedge against dollars inflation because they keep dollar reserves as part of their portfolios. And so they're exposed to the risk of dollar inflation and they need to hedge against it. There's only the only central banks that don't need to have a hedge against dollar inflation are the ones that issue dollars themselves, which is basically the Federal Reserve. It does not need a hedge against dollar inflation. Now, if the Fed held a lot of other foreign currencies, it might want to hedge against those currencies' depreciation. But the Fed doesn't hold a lot of foreign exchange reserves of any kind. And that's because we have a free floating dollar. The Fed doesn't manage exchange rates actively, doesn't need to have foreign currencies with which to manage exchange rates, to interfere in exchange markets. So the Federal Reserve doesn't have any need for any hedge against inflation of any currency, and certainly not its own. Does that make sense?
Yeah, it does make sense, but will there be another currency in the future that could be a de facto global reserve currency because everybody starts trading in that currency, in which case it would be necessary to hold that currency in reserve?
Well, but most reserve currencies that are, you're right. If something became an important international payments medium other than the dollar, then of course that would form an important part, more important part of central banks' portfolios. But mostly central banks today hold hedges, not of different assets, hold different amounts of other foreign currency and hold gold. Other than dollars, right? The stuff they hold other than dollars, they hold as a hedge against inflation, and they hold foreign currencies as well as dollars to stabilize exchange rates. That's what they're doing. They're not trading with these currencies. They're not using them for payments. The dollar is the only thing that they would use in international payments, but mostly they're holding reserves for foreign exchange intervention and for hedging against inflation. So nothing right now is threatening the dollar as an international medium of exchange. That's a myth. The people who are saying it are looking at the foreign central banks are accumulating gold, but they're not accumulating it because they think it's going to take over from international payments from the dollar. They're holding it because they don't think the dollar is going away, and they need to hedge against dollars. You see what I mean?
I see.
It's true that central banks have upped their holdings of certain foreign currencies other than dollars. But almost all the currencies they're holding more of are tiny little currencies. They're not the big important ones. And it has nothing. Some of them are important, but they're not at all likely to become important media of international payments. So they're not accumulating euros or yen. They're accumulating other stuff. And mostly they're accumulating it for exchange rate stabilization purposes. So there's nothing threatening the dollar as a medium of exchange, nothing at all.
If in the future we live in a multipolar world where people trade amongst each other and there's different power blocks, what happens then? We'll be using the yuan or the euro as an example.
Let's just suppose we had a lot of people using Chinese yuan. It became we became a bipolar international system with the yen and the dollar still serving as the main currencies for international transfers, as the invoice currencies for international payments. Then, of course, there would be more need for yen in people's portfolios, in the portfolios of people who otherwise deal in dollars. The U.S. central bank might have some reasons to hold more yen in that case, although not many, because it's not transacting itself very much. It's not in the import business or the export business. So we have to again distinguish what changes in ordinary citizens' portfolios, or what changes would be rational in those portfolios, and what changes would be rational in governments' portfolios, which brings us back to the strategic reserve. As long as the United States doesn't feel compelled to manage any exchange rate, so as long as it's not trying to stabilize the dollar-yen exchange rate, for example, the Fed won't have and the Treasury won't have much need for yen, even if the yen is used more widely as an invoicing currency. They won't have to have it because they're not engaged in those transactions that require it.
What does the next crisis in America look like? And at what point does the government need to intervene?
I don't know what the next crisis is going to look like. I think we agree that high inflation is a threat. And I'll repeat that if to the extent that the cause of rising prices consists of oil shortages and other real shocks that reduce the availability of inputs and reduce production because of it, the best thing that the U.S. authorities can do is let that be reflected in higher prices, because you only make things worse if you try to combat inflation that's due to supply shocks. You only make things worse. But at the same time, the authorities should do nothing that could make prices rise even faster than is consistent with the underlying increase in scarcity. That would be irresponsible, excessively easy monetary policy. So tolerating some inflation when it's due to supply shortages is very important. And there isn't much else that can be done otherwise to combat that inflation except address the shortages, which means get the Straits of Hormuz open again, stop the war, stop squandering resources for it, and so on. So that's one calamity or trouble that we're possibly in for, that I think we will be in for, and how the government should deal with it.
Let's end on this final note here. It doesn't matter what the next crisis looks like or how it will happen. It matters also how the governments around the world will respond to this said crisis. 2008 and 2020 saw a resurgence in the interest in Keynesianism, which is to say government intervention in the face of a crisis. What's your response to Keynesian economics, especially during times of distress? At what point should be the appropriate point for governments to intervene with massive stimulus?
If the only time stimulus is justified is if if spending in the economy collapses, then either through monetary or fiscal policy, whichever one works best. Usually monetary policy is the wisest because it's less distortionary and less wasteful. The government is justified using those tools of fiscal and monetary stimulus to try to make up for lack of demand, which is itself often a result of bad government policies. We live in a world, David, where central banks, whether we like it or not, and I don't like it, central banks are responsible for how much spending goes on in the economy, them and fiscal authorities. And an economy that can't sustain a fairly smooth growth of spending is going to suffer recessions. We want governments to make sure that since they're managing spending, having a big influence on it, that they do it right. So what people call Keynesianism here, I think is really just a call for the government to not blow it in the first place, keep the control of money such that spending doesn't collapse. But if it does collapse, we'll fix it quick. And Keynes didn't invent this argument. It's a misconception. Most economists believed in what we now call countercyclical fiscal or monetary policy. At the time when Keynes wrote his famous book, giving a new twist to the argument. But what Keynes also did that we shouldn't forget that was also very important, he had a lot of things he said the government shouldn't do. In the 30s, to get back to the New Deal, the government is messing around with fine-tuning the whole economy. It's moving towards, broadly understood, some kind of socialism with the NRA and cartels and price controls and the Agricultural Adjustment Act. These are all micromanaging the economy and doing tremendous harm. What Keynes was arguing was, don't do any of that stuff. Just get the monetary and fiscal levers right, so to speak. Just get spending where it needs to be. And I think we learned that lesson, and it's a lot better than the kind of micro interventions that have been tried in the past, which tended to disrupt the market economy a lot more, much as people think that fiscal policy and monetary policy can be disruptive. They haven't seen anything compared to the kinds of interventions that we experimented with in the 30s. We certainly don't want that anymore. If that's the alternative to Keynesianism for dealing with recessions, Keynesianism is by far the better, the lesser of the two evils.
Okay. We'll follow up on that later and see what needs to be done if the next crisis hits. Where can we follow your work right now? I know you've been retired from
I am
academia.
Retired. That's right. Yes. I'm retired from academia since 2014, retired from the Cato Institute since last year. And so I'm not actively writing anymore. I'm taking a break. But my essays from Cato, many of them are up there online. They are discoverable by searching for my name. And Cato at Liberty is where they are hosted. Cato at Liberty is the Cato Institute's blog. So much of my work is available free there. And then, of course, there are books and essays and other things. So even though I'm not writing new stuff, certainly welcome people poking into what's out there. And they'll find that I've written about all kinds of things. So with luck, they'll find something of interest.
Okay. Thank you very much, George. We'll put the links down below. Follow George there. We'll speak again next time. Take care for now.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.